Assalamualaikum. Welcome to video 25 IFRS 2 share-based payment. This standard is only applicable for SBR students and it's a technical standard and it has a very high chance of appearing in your SBR exam since it's newly asked in SBR, not asked in FR. So, a share-based payment is a transaction in one where an entity obtains goods and service from other parties with payment taking in the form of shares or share option. That means rather than paying in cash for buying goods and services, you are paying them in shares or share options. There are two types of share-based payment. First, equity settled, next cash settled. Equity settled share-based payment when an entity receives goods and service in exchange for equity instruments. That means shares or share options. Cash settled means entity is receiving goods and service in exchange for a cash amount that is paid based on the share price. Now, in your exam, you can be asked any of the two. Equity settle, cash settle, or both in same question. Now, the accounting treatment. If an entity issues share options to their employees, so that means, see, for example, your employees are working for you. What are they doing? They are giving you a service, okay, by working there for n number of years. Rather than you paying them only in cash by giving them salary or wages, you are paying them share options in your company or shares. So that is share-based payment. Okay. So how do we account for that? Entity If an entity issues share options to employees, then you have to take the fair value of the option at the grant date. That will be used as the cost of your service that is received, not at any other date. For cash settle, the fair value of goods and services will be measured and a liability will be recognized. Remember, with cash settle, liability. Okay. The liability is remeasured at each statement of financial position date until it is settled with the changes in value being taken to statement of profit and loss. That means any change in the fair value, gain and loss will go in the statement of profit and loss. The expense in relation to the share-based transaction must be recognized over the period in which services are rendered or goods and services are received, which is known as vesting period. That means, let's say you an employee have been there for 5 years. So over the 5 years, you will recognize this share-based transaction, which is an expense. You will recognize for the 5 years it as an expense of giving shares to your employees. This is from the employer's perspective we are talking. Okay. Now, grant date. Some keywords are very important when it comes to IFRS S2. Grant date. The date a share-based payment transaction is entered into. Vesting date. The date on which cash or equity instruments will be received by the other party to the agreement. Example. A company is granting share options of 5,000 shares that is due to vest in 5 years' time. Fair value of the option at the date of the grant is $3. So now you are assuming that you will be there for the 5 years and you will take up this option. So how are you going to find the fair value? At the grant date, which is given as $3. So 5,000 into $3, 15,000. This 15,000 you will spread over the vesting period. How many years are there? 5 years. So this 15,000, okay, you will vest over 5 years. That is 15,000 divided by 5, 3,000. So every year you are going to record 3,000 in your statement of profit and loss as an expense. Each year, and each year the cost has to be remeasured to take any adjustment in that remeasurement will be taken to statement of profit and loss. And the entry side, okay, you have to credit the equity. The credit entry will be in the equity for the share options. Now, at the end of year 2, what is happening? Only 4,000 options will vest, let's say. Then how do you account for it? So the total cost of the scheme, 4,000 into 3, the fair value of the grant date, which is 12,000. Okay. Now, this 12,000 you have to take into 2 divided by 5 because total vesting period is 5 years, but you are in the second year. So into 2 divided by 5. So a cost of 4,800 will be recognized in year 2. Since you have recognized 3,000 in year 1, now your cost increased to 4,800. Only the difference you will recognize in year 2. That means from 3,000 it has increased to 4,800. The difference is 1,800. So in year 2 you will only record 1,800. The difference, not total 4,800. Okay. Now, assuming there are no further changes in the number of shares that are expected to vest, 2,400 will be charged to your statement of profit and loss in years 3 to 5. Okay. Now, exam kit questions are Margie, Lubloid, Semble. Thank you for watching, and make sure that from your SBR revision kit you have to do questions on IFRS because it's a technical area and students often struggle in IFRS 2. Okay, so make sure that you do lots of practice in this area. Now, the next standard is a favorite topic, that is group accounting, which is IFRS 3, that is business combination, which is needed for your group accounting, applicable for both FR and SBR students. So let us go to the next video, which is IFRS 3.